life went better if you behave better yourself.
I mean, the game is very, very, very easy if you have the right
logic rather than emotion. I went through many, many years doing the wrong thing.
I said investing is just about assigning yourself the right story.
Hello and welcome back to Biz Bucks. Warren Buffett, the renowned investor and the chairman of Berkshire Hathaway, has been receiving significant attention due to the vast amounts of cash the company is currently holding. This situation has raised alarms and prompted many analysts and financial outlets to delve deeper into the reasoning behind this. The sheer scale of the cash holdings is staggering. Berkshire Hathaway's cash pile grew by $9 billion in a single quarter, bringing the total to an astonishing $334 billion by the end of last year. This is the largest cash reserve the company has accumulated, marking an unprecedented amount in the history of Berkshire Hathaway. The primary question on everyone's mind is why? In an effort to reassure shareholders, Buffett made it clear that while Berkshire Hathaway is currently holding substantial cash, this doesn't mean that the company is abandoning its investment philosophy. Buffett emphasized that the cash reserves would eventually be deployed primarily into equities, especially American equities, although some of the companies will have significant international operations. Despite this reassured stance, Buffett highlighted a critical point in his letter to shareholders. He is holding onto cash because he believes there's a massive overvaluation of assets in the market right now. This overpricing, according to Buffett, presents a significant imbalance in the economy. Warren Buffett, known for his conservative approach to stock investment, has been seen as a voice of reason, and his philosophy has been built on the principle of buying undervalued stocks. This approach has made him one of the wealthiest individuals in the world. His long-standing strategy focuses on acquiring companies that are undervalued relative to their potential, especially when their stock prices are mispriced. This style of investing, based on careful analysis of a company's financial health, has allowed Buffett to avoid market fads and speculative bubbles. At the core of Buffett's investment approach is the idea that he doesn't rush into buying assets unless they're priced correctly. Given his long track record of successful investments, it's clear that he takes his time to find opportunities that align with his values and strategies. This careful and measured approach is now more crucial than ever, especially when looking at the current economic conditions. As many analysts have pointed out, the significant cash reserves that Berkshire Hathaway holds may be a response to what Buffett sees as an impending market correction. He has alluded to the possibility of a future downturn or crash, and thus he wants to be in a position to buy assets at more favorable prices than what the market does adjust. This approach of holding cash during uncertain times is not new to Buffett. Over the years, he's built up cash reserves and waited patiently for the right opportunity to deploy these funds. Whenever Buffett sees an asset as overpriced, he typically refrains from purchasing it, holding out for the eventual correction. This strategy has proven to be successful time and time again, but it also highlights his cautious outlook on the current state of the market. In addition to Buffett's positioning, another important trend to watch out for has been the behavior of other billionaires. A growing number of wealthy individuals like Jeff Bezos, Bill Gates, and Mark Zuckerberg have been reducing their exposure to the stock market. These individuals have been selling off significant portions of their stock holdings, which could be seen as a signal of growing uncertainty among the ultra-wealthy. When these billionaires begin to mitigate their risk, it can signal broader economic concerns, especially in the face of a market that's heavily reliant on just a few major tech companies. The dominance of the tech sector is driving market growth and has been evident for the last few years. The rise of AI and the continued success of big tech has largely been responsible for the positive performance of stock market indexes, including the S&P 500. However, the recent developments in AI, particularly in China, have raised concerns about whether the tech sector is overvalued. Some analysts have pointed out that the possibility of an AI bubble forming, similar to the dot-com bubble in the early 2000s, when the rapid growth of the internet-based companies led to inflated valuations and a subsequent market crash. The key question now is whether the optimism surrounding AI and tech stocks is justified or whether it's a speculative bubble. The issue of overvaluation becomes even more concerning when factoring in other macroeconomic issues that contribute to the current economic instability. One such issue is the housing market, which remains in a difficult position. Home prices have reached record highs, with the median price for a home sold in January hitting $396,000. In metro areas such as New York and San Francisco, the average price for homes is closer to $1 million. On top of this, mortgage rates have remained high, hovering around 7%. For most individuals, purchasing a home in these conditions is virtually impossible. The high cost of ownership and the increased difficulty in obtaining a mortgage have resulted in many potential homebuyers staying out of the market, which in turn caused a slowdown in home sales. The housing market is often considered a bellwether for the broad economy. When housing prices are high and home sales are low, it indicates that many Americans are struggling to make major purchases. As homeownership has traditionally been a key way for Americans to build wealth, this stagnation in the housing market raises concerns about the long-term stability of the economy. Furthermore, the high prices and interest rates in the housing sector are having an outsized impact on middle-class Americans. The inability to afford homes or save enough for a down payment means that they're stuck renting, and their ability to accumulate wealth through homeownership is severely limited. In addition to housing, other economic indicators are pointing toward potential issues. Consumer sentiment, for instance, has been on the decline, as raising tariffs and inflation fears have taken their toll on consumers. Consumer sentiment measures the confidence people have in the economy and their ability to spend money. When sentiment falls, it typically indicates the consumers are becoming more cautious, which can lead to reduced spending and economic slowdown. In February, consumer sentiment fell by 10% from January, marking the second consecutive month of decline. The decline was more pronounced among Democrats and independents, though Republicans still showed relatively positive outlooks on the economy. The current economic situation has many potential flashpoints. A correction in the stock market, for example, could have significant consequences for consumer behavior. The wealthiest individuals, who currently account for a disproportionate share of consumer spending, could curtail their spending in their portfolios if they lose value. This would have a ripple effect throughout the economy, especially considering how much of the stock market's growth has been a driver by handfuls of tech giants. If these companies were to face a downturn, it could trigger a broader market correction, potentially leading to layoffs, a rise in unemployment, and further economic uncertainty. In the event of a market correction, it's possible that we could see a scenario similar to the high stagflationary environment of the 70s, where the economy faces a combination of high inflation, rising unemployment, and stagnant economic growth. This type of economic environment can be particularly challenging for households that are already facing the pressures of high costs for essentials like housing, healthcare, and education. The increasing concentration of wealth in the hands of a small percentage of the population is also problematic, as it means that any changes in the spending behavior of the top 10% could have outsized effects on the broader economy. Another concerning factor is the growing disparity between the wealthy and the rest of the population. The top 10% of the earners in the United States are currently responsible for over 50% of consumer spending. This concentration of spending in the hands of the wealthy is a sign of economic inequality, and it suggests that the broader economy may be over-reliant on the purchasing power of a small group of people. If these individuals were to reduce their spending, it could have a devastating effect on the overall economy, especially if the rest of the population is unable to make up for the shortfall. Given these factors, many are beginning to ask how long-term the current system can continue. The concentration of wealth, high asset prices, and declining consumer sentiment all suggest that a major correction could be on the horizon. For Warren Buffett, his decision to hold cash is a reflection of his cautious outlook on the economy. While it remains to be seen whether his predictions of an impending crash will come to fruition, the current state of the market and the broader economy are definitely cause for concern. As we move forward, it will be important to monitor the behavior of the stock market, the housing market, and consumer sentiment. These indicators will provide valuable insights into the health of the economy and whether we're heading toward a major market correction. Until then, Warren Buffett's massive cash reserves will continue to serve as a reminder of the need for caution in times of economic uncertainty.